and welcome to Economic Solutions. I'm Leonard Zane. This is the second program we have in the series, and today we're fortunate to be joined by banker Byron Schatz.
Well, thank you very much for having me. I've been working in the mortgage and finance industry now for 20 years.
20 years. Well, we're going to tap some of your expertise, I hope, and help.
I look forward to it.
Have you help our viewers guide through this current economic crisis with some ideas that maybe our government is not even presenting at the moment. I'm really thrilled to have you because this program is very important. It's concentrating on the picture in the community, on how can we individuals really deal with this economic crisis, and what kind of help can we get from the government's help rather than banks getting all the aid or the finance industry being rescued, as we hear so much. But this program is about mortgage and rental relief. It's about doing something about our monthly debt payments that we have and also our rental payments. So I'm very excited about this program. Last time, to sum up a little bit, we covered the aspect of getting into and out of a depression. Now, we don't know right now whether we're in a depression or not. We know we have an economic crisis, but we did summarize last time the Great Depression, how we got into it with various monetary policies that contributed to it very greatly by the federal government, and how we got out of it with a tremendous leap in productivity that was sponsored by government, actually, at the time. And it was very successful during the early years of World War II, where we actually tripled the index of industrial production in 2.5 years from 1940 to 1943. We're also going to talk a little bit today about government investment in infrastructure. That'll come later in the program. We did summarize it last time, where the government can come in and help to rescue a situation with an investment program that is not merely just spending. It's actually an investment in things like infrastructure toward greater productivity that maybe corporations with short-term earnings outlooks have not focused on, and so have cut back on some of the longer range benefits that we have. And so now if we move on to current things that the federal government is doing to assist mortgages that people have and families in particular. The government has a plan right now they've put forth that they say will aid up to 9 million families, $275 billion in aid, averaging $30,556 per family whose home mortgages are no greater than 105% of home values. And I'll bet you have something to say about that.
And that's one of the problems. And speaking with a lot of mortgage brokers that I've worked with in the past, they tell me that there's a lot of people calling them up that are well above this 105%. In addition, you have to be able to qualify. And that's been a problem for a lot of people as well. So there's a lot of people that aren't able to be helped under this current economic plan for the mortgage crisis. And the 105% is probably one of the largest things to have to deal with for a lot of homeowners, especially in certain areas, much like our Inland Empire here.
So this is what you people in banking call being upside down on your mortgage payments?
Correct, or negative equity, either way. Upside down.
Where your mortgage is greater than your equity in your home, and the 105% limit isn't going to help you too much if you're more upside down than that.
And those are the people that are probably in the most danger of foreclosure because they don't have the motivation to hold on to the house.
Okay. And then what's this 10% tax credit?
Right now, the government, for first-time home buyers, has a 10% tax credit, or up to $8,000 is the maximum currently. There are some income restrictions for that as well, but that's helping get more demand for housing out there by allowing first-time home buyers to step into the picture now.
Okay, so my children, therefore, can qualify when they go to buy their first home and get up to $8,000 in tax credit or 10%.
That's correct, and that'll really help people and maybe get some of the people that are on the fence about buying off the fence.
Okay.
But one of the problems that we've had and how we got there was through rapid appreciation. And a lot of this rapid appreciation caused a lot of people to pull cash out of their homes. In fact, back in 1998, there was about $40 billion, and these are just prime conventional loans only, that doesn't take into account the subprime market, of actual cash pulled out of the house. And by cash out, they're talking about loaning above what's owed against the property. And people use that cash and pumped it back into the economy. I'd hate to think what would have happened to the economy. We would have had this slowdown much earlier if all this cash wasn't pumped into the economy. You could see during 2006 it hit its peak at $318 billion. And again, this isn't taking into account the subprime market. The subprime market grew. In fact, when I first started in this business, subprime is the place you went to go get your loan if your credit wasn't the best, and they required a greater amount of equity and will lend you money at a higher rate. What subprime became is a place to get 100% financing for people that had good credit. And so there was a lot of people that didn't have any financial interest in their property. And then there were a lot of people using their house as an ATM machine and kept pulling the money out of the house. And that caused the problem. As you could see, as appreciation train moved on, so did the amount of cash out that people were pulling out of their house.
So this was not really a great idea then, this was overextended, is what you're saying.
It was
right?
overextended, but again, the banks were trying to keep up with the subprime. There was also a lot of portfolio lending, a lot of stated income type of loans, but it's mainly the amount of cash out, and if you did an 80% cash out loan in 2006, you're probably upside down on the house now.
So this is how we got into trouble then.
Mm-hmm. In fact, this shows the amount of negative equity as a percentage of loans that are outstanding, and you can see the states that had the greatest appreciation are the ones that are in the most trouble. Nevada leads the pace on this with a 55.1% of all mortgages are currently negative equity or upside down. You could see that Arizona, Florida also, Michigan. I heard the average sales price in Detroit is like $18,000 now.
Gee, I should buy a home.
In California, it's 29.5%, and again, it's really affecting communities that had newer development, that had development since 2000. In fact, a lot of these communities, every other house is in foreclosure, and a lot of it has to do with the negative equity. People don't have the motivation to keep these homes because if you have a $300,000 house and you owe $350,000 on it, the motivation's not very great.
Okay. So Byron, let me ask you, what kind of a plan can be presented in this program that does not exist right now from the federal or state governments or other agencies? What can we do to help homeowners that's really not happening at the moment? I see you have some goals here.
Well, right now we're giving money to the banks, and a lot of people are upset the way it's been handled, the auditing, the accountability of that money. The goal of this plan is to help stabilize the housing market, for one, and that'll benefit all homeowners. It's the sharp decline that's causing a lot of lack of consumer confidence. People don't feel as rich when they don't have equity. Mm-hmm. But I'd also like to be able to minimize the taxpayer cost for this. As we mentioned, we're giving billions of dollars to these banks, but the problem, they're using this money for bank liquidity. They're having to do write-downs, especially those that have large mortgage portfolios. And these write-downs aren't actual losses, they're potential losses. But they're struggling to meet capitalization requirements. And so the money that's being given to these institutions now is used to just meet their capitalization requirement. It's not being lent back out and opening up the credit markets.
So it's not helping us?
Correct.
Okay.
And what we want to be able to do with the plan is to help responsible homeowners. And also minimize the shareholder burden, because a lot of these people that bought shares in these banks weren't the ones that managed it, but they're being affected as well. So the key elements of the plan is to open, through FHA and HUD, a mortgage division. And this mortgage division is a place that these banks can trade these types of loans for shares in the bank.
So this is a brand new division then that would come under FHA HUD?
That is correct.
Okay.
And what they would do is they would take on these toxic assets from the bank, and the bank in turn would get shares in this new mortgage bank. In order to qualify to be able to put there in there, you have to be an FDIC insured institution. Now FDIC means the government is basically backing their money, which means us, the taxpayer.
Okay, so let's say I'm a homeowner and I've got a mortgage. How does this plan help me get out of trouble?
Well, you have to be able to qualify under this plan, and one of the qualifications is that you have to be upside down or have negative equity. As we have mentioned, there already is a plan in place to help people that aren't upside down or up to 105%, but this will address some of the concerns for people that are over that aren't able to take advantage of the plan. Also, you have to be behind on the mortgage.
Why is that? Can't they just help you anyway for being a responsible payer against your mortgage?
Well, being a responsible payer will mean your credit will be clean, but even under the current plan, there's no more than one 30-day late allowed in the last year. The people that are current on their mortgage aren't the ones that we're concerned about going into foreclosure.
But can't we help those people who are struggling? I mean, it's like almost punishing them for being responsible. I mean, let's say I'm struggling on my mortgage. I mean, I'm not behind, I'm not missing payments, but I'd hate to have to miss payments in order to qualify. Something seems wrong about that.
Well, I agree with that, but there's only so much money to go around. And the toxic assets are the ones that are going to go into foreclosure where the bank's going to take a loss and the taxpayer's going to have to make that up anyway. So with this mortgage qualification, you do have to be behind. You cannot be upside down. And what we would do is offer the borrower a 40-year loan at 0% interest for the first 5 years.
Oh.
Which means every dollar of what they're paying then would be going to reduce their principal balance. And you have to remember, these are people with a negative equity position. The first 5 years' payments would be based on a 30-year amortization. Therefore, they're able to pay more and pay down the mortgage, so hopefully in that 5-year period, they will not be in that negative equity position.
So they're paying principal only then for this 5-year period and 0% interest, which is going to lower their payments considerably then.
Definitely. In some cases, it'll be lower than rent.
And this is certainly something that the federal government is currently not doing.
That is correct. Again, they haven't addressed this negative equity position.
So here we are in our local community of Monrovia, and we could benefit by having a plan like this because suddenly we folks here who have some substantial mortgages don't necessarily have to pay interest at all under this approach if we can get FHA HUD to open up this mortgage division to fund it, right?
That's correct. And you also mentioned that with that, you would, how does it help people who aren't behind? It'll take some of the supply off the market, which will in turn help their house from depreciating.
Oh.
And so a lot of people will be helped by that as well. Also then, after the 5-year period, it would go to a 35-year amortization and they would be charged 5% interest on that.
Okay, so then it returns to normal, you might say, and they're back to 35 years to go.
That is correct. And by taking that amortization out, it also helps keep the payment lower and limits the payment shock. And again, they will have reduced their balance. Here's an example of some of the loan payments under the plan. We did this on a $200,000 loan amount, which is probably the typical loan that's out there in the United States today. I know the numbers are probably a little bit greater here in California.
Well, we're going to deal with examples. We'll have examples that are $300,000 later. But okay, let's say this is for the whole country.
So at 0% interest based on a 30-year amortization, your new payment would be $555.56. In many cases, that's going to be a lot cheaper than rent, giving them further motivation to hold on to that property and not walk away even though they're in a negative equity position. Now, this payment doesn't include taxes, nor does it include insurance. It also doesn't include a servicing fee, which I'll talk about later for the first 5 years.
Oh, okay.
Now, after the 5 years, what will happen is the payment then goes to a 5% interest rate based on a 35-year amortization. So after 5 years, remember, every penny of this $555 payment is being now used to reduce the principal balance. So your loan amount after 5 years would be $166,666.
Wow.
That payment would be $841.14, and again, that doesn't include taxes, nor does it include insurance.
That's really brought that mortgage balance down significantly.
Well, again, every penny, since there is no interest, is going to reduce the balance, again, getting people out of this negative equity position.
And it's affordable. Okay.
So other key elements of this plan is that the homeowner continues to pay their taxes and insurance. And right now there's a lot of homes where people aren't paying the taxes, and we all know that we need every bit of that tax dollar, especially in today's struggling economy. In order to give further motivation to these people, you can only write off the interest when you pay a home mortgage. And since they're not paying interest, the way I envision this is 75% of your principal payment for that first 5 years would be treated as if it were interest for tax purposes.
So it would qualify as interest and give people the tax write-offs, even though they're only paying principal.
Correct. Yeah. A lot of people own homes just for the tax write-offs, and this gives them the benefit of still having that tax write-off even though they're not paying interest, giving them further motivation to hold on to that property that they have a negative equity position in. But there's penalties and restrictions to this. One of the things is they have to be committed to the property for the first 5 years. They cannot sell this property during the first 5 years and net any money, even if the property goes up in value, because we want people to be committed to this. And again, keeping the supply side down, which will help get us out of this depreciation that we've had in terms of home values.
Now, can they sell at no gain?
Sure they can.
Okay.
And in fact, they may be in a position where if they were transferred or had to move, that they would have to sell, and the banks may have to accept a short pay in such situations if appreciation hasn't taken us out of the mess that we're in.
Okay, so they're not going to be able to really profit from this plan, which one could certainly exploit this idea.
Sure, and that's why you cannot net any money for the first 5 years under this plan. We would also not allow any secondary financing for the first 5 years. You couldn't pull out a line of credit or borrow any further money against this, because again, the goal is to get people out of the situation that they're in and not put them right back into it.
Okay, and so therefore no second mortgages kind of thing?
Correct.
Now, if they already have a second mortgage, does that apply in some way to this?
Well, it depends whether it was an FDIC insured institution that holds that.
Oh.
Are we going to have to pay for that in the long run, in which case we might as well take care of it now. But for a lot of people, I had envisioned this more of as a first mortgage situation, and on the current plan, where you can refinance up to 105, it does not include secondary financing.
Oh, so you can't refinance in the plan you're proposing to put everything into a first, maybe, if you had a second in addition to the first?
Again, it depends who holds the paper. If it's held by FDIC-insured institutions, which means we're on the hook for it anyway, then it would be included in this plan. If it wasn't, then too bad.
Okay.
Now, in addition, the homeowner is going to pay about a $50 a month servicing fee to cover the cost. Now, typically servicing fees are about 1/4% of the loan amount per year. And the way I had envisioned this is it would still be about 1/4% of the loan amount per year with a cap of $50. And that way it would cover the servicing costs of this.
Good. So it pays for actually managing and administering the plan.
Correct. And then after the 5 years, the servicing costs would go away. That would be absorbed by the 5% interest rate that's being charged at that time.
So at least the government won't be at a loss with regard to operating costs for administering the plan.
Correct.
Yeah,
In this situation, then the banks are getting their money back, though they may have to forgive some interest due to some of the bad decisions that they made.
Okay, so what about how would the FHA HUD Bank handle foreclosed properties?
Well, again, as I mentioned, for this plan, you do have to be delinquent. And people that don't agree to this plan have a choice of either bringing their loan current, or the house will go into foreclosure. Or if they don't continue to make these lower payments on time, they'll go into foreclosure as well. But one of the thoughts I had is offering these foreclosed homes under the same terms to a new class of qualified buyers. People would be willing to pay more for the house if they knew they could get a 0% interest loan for the next 5 years and a guaranteed 5% interest rate thereafter for a 35-year term. And therefore, I think people would be willing to pay more, and if they wouldn't be willing to pay more, pay as close to it as possible, therefore limiting the loss to the banks.
So you're talking about certain types of people in our community. You've got here veterans, school teachers, police officers, firefighters, and other community service professionals, and you would give them a special rate on their mortgage interest?
Sure. Again, for the first 5 years, since they'd be in that negative equity position, they'd be able to make these principal-only payments with 0% interest, and then after that term, give them a 2% interest rate after that initial 5-year term. And therefore, it benefits some of these professions that we'd like to pay more money to, but we don't have the money to pay them anymore at the present time.
It kind of rewards people for community service. I wanted to talk a little bit about that as regards Monrovia here where we are, where this telecast originates. First of all, we do have hundreds of veterans here in our community. We have about 100 police officers and firefighters. We have hundreds of teachers and hundreds of city employees, and this averages out to 1 person for every 10 local households here that actually would be eligible for this 0% situation if they are sold a property like this and then they go into the 2% interest rate. We could actually end up helping 1 person out of 10 households here in Monrovia itself. So that is not insignificant, and I think I like this aspect of the plan where you're looking at people who have served the community and who are helping us grow. Education, of course, is a big priority right now in our whole national economy, and here's how our community could participate in that kind of incentive.
So to summarize some of the plan's benefits, it's helping stabilizing the housing market. This will benefit all homeowners. I had originally envisioned it for owner-occupied, but it will also help investors as well by stabilizing the market. And I know that you've also have some more thought on the investor side of the market. Mm-hmm. It's also going to relieve the most heavily impacted areas. Again, places where the average family bought a house since 2000, where there's been newer development, tends to be the ones that have been hardest hit by this foreclosure crisis. And this will help relieve some of those heavily impacted areas because there's whole communities that are upside down on their mortgage. It also makes the borrower responsible, though. They borrowed this money. They're going to have to pay it back, but we're going to help them, but they have to pay back every dime that they borrowed.
Now, how does this minimize taxpayer cost?
Well, one of the things it's going to do, it's going to open the credit markets by taking some of these toxic assets off the books of these banks. They're no longer going to have to do the write-downs that they've had to do in the past, which will free up and it'll help taxpayers by opening the credit markets, but it's also going to limit the amount that we're spending. Mm-hmm. We're going to have further and further write-downs of these banks if the housing market is not stabilized.
Okay. So what I'm hearing you say, Byron, is you've presented a plan for helping average folks who have mortgages, but they do have to be delinquent. That's the one thing that still bothers me a little bit. But you at least have provided a way to help people who are upside down by more than this 105% ratio, which I think a lot of people are facing right now. And so you've come with a way to actually allow them to both pay no interest and lower their principal balance over 5 years substantially, then get back to pretty normal terms, but at 5%. So this is really acting to save people's homes and to make this work. You haven't addressed renters in this, and I'm going to do that. But you've covered if the crisis doesn't turn into another Great Depression.
Correct.
Your approach will at least help us from going into another Great Depression.
We're hoping that by being able to put this plan into action now that we won't get to that situation, but it could happen.
It could happen. Now, I wanted to cover what if things do really get dire? I mean, what if this crisis really does turn into a depression that nobody can do anything about? These values are going to come crashing down no matter what we do. There are a lot of economic authorities today who believe that no matter what we do, we're going to have to go through an adjustment, even though the government is helping and they're restructuring and they're coming in with infrastructure, stimulus, and that kind of thing. So what I've come up with some ideas on what we could do if we really do have a depressionary situation that has descended on us. And so I'm looking at a worst case scenario here, deepening crisis. I'm saying, well, what if we have a 3 to 5 year depression, and that means a depression is at least 15% unemployment. And of course, we should find some way of counting self-employed people here because we're currently understating even the unemployment today, that I think at 8.5 or whatever it is. That's not really how many people are unemployed when you count the enormous number of self-employed people we have. It's worse than that.
And in terms of qualifying, a lot of those unemployed or the self-employed people have trouble qualifying due to taking full advantage of the tax laws that are out there.
Exactly. So from that standpoint, we could be getting on the brink of a depression right now, if we have one. I've come up with an idea that let's say if we really go into a terrible economic plunge and an average family's income drops by as much as 40%. I'm thinking what can be done as a solution to keep people from losing their homes and renters likewise from losing a roof over their heads, to avoid the situation like we had in the 1930s where people were out in the streets. Is there a way that that could be done? And I believe there is. I'm saying, let's say the average homeowners can pay, under this crisis situation scenario, only 60% of their monthly mortgage payments. Housing renters, though usually the proportion isn't so great for renters in terms of relative to the mortgage payments, so I've said, well, let's say that renters can pay 75% of their monthly rent. And let's look at a 5-year financing program that will help stem the housing crisis. All right, and this is what I call an economic crisis safety net. The idea here would be the government subsidizing needy qualifying mortgage payments for 5 years by up to 40%. Now this is calamity situation. This is what, Byron, you're hoping to avoid and avert. But if we get to this, the name of this program is Economic Solutions. We're trying to cover our bases here. What if it's worst case scenario, dire circumstances? Okay, so people could qualify for up to 40% subsidy on their debt service. Banks would have to accept no more than 5% fixed interest, and we're already assisting banks to a great degree right now with their toxic assets. So do you think 5% is a reasonable figure that banks can accept?
Well, at this time, interest rates have come down. The purchase of treasuries has helped keep interest rates low, but I think 5%, let's put it this way, they'd rather have 5% than nothing.
Than nothing. All right, very good. Now, let's look at renters. And what I'm saying is that aided homeowners who rent, first of all, must qualify for HUD Section 8. Now, if this happens, if you own a home and you're going to rent to somebody, and you are renting to somebody, you would have to qualify for Section 8 to get this kind of 40% subsidy on your mortgage payments. Then this allows, under Section 8, subsidies to renters, and I'm going to cover a little bit about how much a renter can be subsidized under Section 8. It's really dramatic. The program's actually in place. It's been in place, but there's a 5-year waiting list right now. That's the only problem. So under this plan, the loan and rental terms would resume in 5 years or are renegotiated. The loan is assumable on sale during the 5-year term. Now this is, again, making sure that nobody nets any profit on this. That's,
sure.
That's another requirement. And the subsidy program ends after 5 years. Now let's look at what that would look like for a $300,000 mortgage, more like what we have in our local community here. So calamity hits the San Gabriel Hills. People are in really big trouble. They can get up to a 40% subsidy on their monthly debt service. And so this is what the chart looks like. And normally, let's say, they would have an $1,896 principal and interest payment over 30 years, 30-year amortization. But in this case, they would end up paying really $1,138, and the government would pay $758 of that. So that's bringing that way down. In effect, it's 60% of what our mortgage payers were paying before. So this is the subsidy idea on just a normal mortgage, normally amortized.
Now these payments don't include taxes and insurance.
Exactly.
On top of it
Only
as well.
principal and interest, right. Now, if it's really dire, there's also the possibility of interest only for 5 years in this case, and you still get the subsidy from the government. You still get, the 40% subsidy from the government, but in this case, it's interest only. And so, in this case, it's $750 that the homeowner would pay, and the government pays $500. And so, this would certainly be affordable for just about anybody, even under drastic loss of personal income.
Now, the way you envision this was, were they need to prove that they've lost 40% of their income?
Yes, they would have to prove what their monthly income is, and people have to do that anyway when they apply for loans. People haven't always been honest on that, and there have been situations where that information has not been required, right?
That's correct. There was a lot of stated income loans, and that caused a lot of the appreciation due to the excess demand created by the subprime market and a lot of stated income type of loans as well. Okay,
now one of the major factors that we need to ask here is, yes, you and I have come up with some approaches. Yours is a more normalized situation. Let's rescue the current situation. We're not in depression. Mine is extreme, worst case, to keep people in their homes or keep them renting and being able to afford it. And of course, the big question is the cost to the government and to the taxpayer. This is fine. We're talking about this kind of subsidy aid. Well, let's look at cost, first of all. first point I want to make is in the crash that we had late last year, we lost $5 trillion in home values throughout the United States. A huge loss has already happened.
And that did a great thing for consumer confidence, didn't it?
Yeah. Now, some agencies, private agencies, this is John Taylor of National Community Reinvestment, is estimating that up to 13 million distressed mortgages will occur over the next 5 years. And this is again a worst case situation. It could get that bad. So this equates at an average of $200,000 per mortgage, $2.6 trillion of distressed mortgages. All right.
And many of those we're on the hook for because they're FDIC insured institutions carrying that paper.
Okay. Now, under the 40% subsidy plan that I've described, this would equate to subsidy of $5 billion per month to equal the 40% debt service subsidies, or $4.3 billion per month at 40% interest-only subsidies. The total amount for the 5 years is $258 to $300 billion of total subsidies over 5 years. Now again, this looks like a huge cost. You know, people are saying, oh, my goodness, you know, this is a lot to bear.
Well, we're giving a lot of money out already to the bailout with not a lot of accountability.
That's right, and that's going mainly to banks, and everybody's saying, well, you know, this sounds fine, but it doesn't, what happens to me? What am I going to see out of this?
Sure.
And that's what you and I are trying to address in this program. I'll get back to the cost of the government in a moment, but I want to cover the FHA HUD augmented Section 8 assistance, as I call it. Now, we said that you have to meet the Section 8 requirements to get the deep crisis aid 40% subsidy maximum that I'm talking about. Section 8 now subsidizes tenants for the difference between the market rent and up to 30% of the renter's monthly income.
That's huge.
That's huge. So that subsidy is already in place with Section 8. So I'm saying, all right, if you're a homeowner, or you are a person who owns a property that you rent out, it theoretically could be apartments and should be apartments, then you have to get this aid, and you're going to want it, you're going to want the 40% subsidy to help you keep you owning your apartment building, you're going to have to qualify for HUD Section 8. When you do that, then your renters are going to qualify for up to 30% of their monthly income being covered by the federal government. Now that sounds great, the program's already in place. However, there is a 5-year waiting list by qualified tenants trying to enroll in Section 8. So this equates to the government having to fund $6.5 billion more to meet the demand. Now this
That's just current demand.
No, this is $6.5 billion more for the current demand, actually, and it will continue.
What do you think that demand for Section 8 would be if we actually did worsen?
Well, if it were this bad, I mean, if it were what it is now, let's say it's 5 times that, you know, so let's say it's 35 billion, but we just talked about hundreds of billions of aid. Now, again, the question that comes up to people is this a waste? If the government puts this money out, isn't this just money thrown down the drain? Actually, it is not. I want to recall a presentation that we had in the first Economic Solutions program. This is how the United States tripled the index of industrial production in 2.5 years due to a war. Now, we were not hit by any bombs in that war, so it didn't damage our productivity. But I show this curve to show what's possible in terms of an investment stimulus program on the part of the government that actually leads to enormous productivity and increased wealth by the whole economy. This is not money just thrown down the drain. This is an investment. And at that time, when this happened here, the federal government had actually invested 40% of the gross domestic product in that period of time. Wow. 40%. We're talking fractions of that. I mean, no more than 10% maximum. So my point here to our viewers is you need to think about investment of what the government can do to get us going that will actually lead to productivity and wealth, not subsidizing just for the standpoint of covering somebody's loss. This is about growth. Look at the growth that this caused from the 1930s up here to the 40s, and it stayed high even after the war. We may not be looking at this ability of raising growth by that much, but when I hear people or doomsayers saying, oh my gosh, how are we going to get out of this problem? And if the government spends all this money, it's money lost and it's wasted. No. History says no. If it's done intelligently, and it's done to support the infrastructure, and it's done to support productivity, then those tax revenues are going to come back too by these people where they're going to have jobs. We're all going to have jobs. We're going to stay in our homes. Our renters will be able to pay the rent. And we will have a wealthier economy. Not a 3.5% growth of the GDP, maybe 10, 15, 20% growth in the GDP. That's possible if the government comes in intelligently in infrastructure and assistance. It really can happen. There are risks of pork barrel in these things, and we know that. And we do need to hold the federal government accountable. They're claiming now they're going to go on websites and we can check where all the money goes and all this kind of stuff. It'll be interesting on your plan. Who got the subsidies?
Well, with my plan, the subsidies actually go to the homeowners.
That's right.
As opposed to the banks. So we're not having to worry, and we have a little bit more control. As we mentioned, also you're investing money, but you're getting the tax revenue of the property taxes, by housing levels and the appreciation, or actually stabilization, I should say, of the market. It'll also help create further revenue for the government by having that property tax.
That's very good, Byron. That's right. Now, to summarize our program here, we've covered a lot of things here in a short time. We've come up with some alternative solutions, both for, let's call it a relatively manageable crisis situation to a depressionary crisis situation. We've provided scenarios on how government can partner with private individuals to get us through this situation over 5 years. We're saying it's not going to last more than 5 years. We know that the Swedish depression lasted about 3 years, and that was a worst case situation. So we've provided here a ready safety net for a deep crisis if things get really bad. We've provided that responsible homeowners can keep homes and avoid greater mortgage debt. We've provided that there can be affordable rents for tenants of aided housing loans under Section 8, and we're going to make sure Section 8 is properly funded so that this waiting list disappears, and it should disappear anyway. And those people can be productive once they've got a place to live.
Sure.
The subsidies cease after 5 years of economic recovery. Banks receive viable income that they can further lend and do what they're supposed to do. You know, instead of hanging on to this money to try to boost their failing capitalization, they can actually lend this money out and get our economy going again. And then, of course, this money they're lending out and the fact that people are in housing and paying less of payments means higher consumer demand for economic recovery. So these are ideas that we are advocating from this community right here that Washington has not presented. We want Washington to watch what we're presenting here. We want them to pay attention to us people down here in the grassroots. That's what this program is all about. We are not funded by any kind of political interests or any kind of special interests or positions. We're looking at this of, hey, how do we get through this situation if it's fairly manageable or if it's really deeply recessionary? Do you have anything you want to add to this, Byron?
Well, like I said, my main concern is to help out the current homeowners. And like I said, I talk with mortgage brokers every day who are getting calls from people that they're just not able to help. And I think by stepping up and taking advantage of a plan to help stabilize the market, this will help some of those people. And right now, there are people that are more than 105%. They're dependent upon those investors to forgive the balance if they wish, and many of them are not doing so. And it's causing an effect where it's just a ripple effect where now your house is in foreclosure, your neighbor's in foreclosure, and it's bringing down the values and it's spiraling. And I hope we can get out of this spiral, and I hope that plan would help that.
Right. Well, I think we have presented some viable ideas here. This is a program about ideas. Byron Schatz, I want to thank you again for coming to the program.
Thank you for having me.
It's great to have an expert like you who's got, you know, a score of years of experience in banking. We cannot mention any of your affiliations right now for this program. We are not advertising anybody or anything like that, but I say we're very lucky to have you on this show. We hope you all have enjoyed what we've presented here. If you like the ideas, let your congressman know, let the station know, call in, let us know what your feedback is. If you think you may believe what we're saying here, or if you think you've got some better ideas, or whatever you may want to volunteer, we'd love to hear them. Thank you very much, and we look forward to you joining us next time.